In this video, I will teach you a strategy that made a watchman with no prior trading experience millions of dollars simply by being a part of one of the largest trading experiments, known as the turtle trading experiment. What exactly was this experiment and how can you be a part of it? Stay tuned because in this video, I will explain what the turtle trading experiment was, what strategy did they use, and how can you implement the same strategy and make insane amount of profits. What is the turtle trading experiment? In 1983 in Chicago, two traders, Richard and William, had an argument in which William claimed that trading is a natural talent and it cannot be taught, whereas Richard claimed that trading is a skill that anyone can learn. So it was an argument about nature versus nurture. This debate became so heated up that Richard decided to conduct an experiment in which he would select multiple people from random professions and backgrounds and teach them the art of trading in order to prove that William is incorrect. He went out, posted banners, interviewed people, and chose a few people he dubbed the turtles. He taught them the strategy and the rules, and they went on to make $175 million in 4 years. Today, I'm going to teach you the exact same strategy that turtles used to make $175 million. Before we begin, there are a few things I would like to tell you about the strategy. The strategy is very simple. There are no complex calculations or techniques involved. However, do not underestimate the strategy because of its simplicity. This strategy has proven to be profitable for the traders, that is the turtles, and many other traders. But there is one thing you must remember. You must understand this strategy until the end and do not miss on a single second of this video. So without any further ado, let's get started. A very common saying in the market is buy low and sell high. I know you must have also heard the same thing. However, Richard strongly opposes this approach because he believes that you cannot always predict the bottom or the top of the market, and it is like going against the market. Instead, he insisted that finding a trend, buying the strength and selling the weakness is the correct thing to do because you are actually going with the trend. And that is the entire focus of this strategy. I have break down the strategy in 4 simple steps. The first one is finding the trend, second is entering a trade, third one is pyramiding, and the fourth one is profit booking. We will go on step by step and do not skip to the next step until you understand the previous one. Now, the first step is called as finding the trend. And for this, you will use 2 moving averages, the 100 and 200 moving average. So whenever you see the prices above the 2 EMA, it will be an uptrend and you have to look for buy entries. And whenever you see the prices below the 2 EMA like this, it will be a downtrend and you have to look for sell trades. Now, once you're done with the first step, here is the second and one of the most important one, which is to find the entry point. What you have to do here is find a previous high, then a correction to that high. Now, wait for the price to break out above it, and when it does, you have to enter a trade and keep the stop loss below the correction, a few percentage or pips below the correction. And you have to do just the opposite of this for a sell trade. So let's say the price is below the moving average and then wait for a new low and then a retracement like this. And now after the price breaches the previous low, enter a trade and keep the stop loss above the retracement, which will be over here. And now we will start with the next step, which I consider to be the magical part of this strategy, and that is pyramiding. This is the technique by which you can multifold your profits by adding positions to your existing trade, that is the running trades. And what you have to do here is, once you are in a trade, and if the trade is in profit, wait for another same signal on that pair. Like, let us take this example over here. Initially, we entered the first trade here as we got our first signal. Then we waited and again we got another signal over here. Just this time, we will add half or less amount of the units you added earlier. Like let us say that here you bought 10 units, then here you will add 4 units or 5 depending upon how you are pyramiding. Just make sure your stop loss stays below the previous correction. Now let us say again the price moves up and then again we got the same kind of signal. Like the price moved up, then a correction, then a breakout. After a breakout we entered over here. And now this time we will add even less units than the previous one. Like let us say we added around 4 units earlier. So this time you will add 3 or 2 units. Again based on the market condition and how strong the rally is. Then again the price moved up. then again we got a correction, and the price again breaks out of it. So whenever the price breaks out of it, that means we are buying with the strength, right? Breakout means that the party which is ruling the market is in strength. So we will again add 1 or 2 units as per the strength of the trend. All you have to do is just make sure that your stop loss always stays below the previous 2 corrections, or the previous correction at least, if the trend is very strong. Now, there are various ways of pyramiding, and based off its different types, each is used as per different market conditions. Now, if you want to learn about that, then make sure you subscribe to this channel and also like the video, as soon as this video reach 1000 likes, I will upload the next video that will be of pyramiding, or how to compound for profits. Now, the next step is profit booking. Richard believed that the most important thing in trading is to know when to get out of a trade. If you do not know when to get out of a trade, you won't be able to book the profit. And if you are not able to book the profit, you will just keep on losing money. Have a determined fixed rule for it, and always follow the rule no matter what. So let's learn about that. And for that, we will take just the previous example, which is over here. Here you can see that the price was moving up and we were adding the positions, right? So the entire time the price was above these 2 moving average, which we use to find the direction of the trend, right? So after we find the direction of the trend and we entered our trades, how to know when to exit? So there are 2 ways to know that. The first one is using the higher high and higher low technique, and I already have a video on that, and you can check that out by clicking the I button over here. So how the higher high and higher low technique is useful is, let us say this was the high, then a higher low, higher high, higher low, higher high, higher low, higher high. So in an uptrend, the price is doing this. But if the price does opposite of it, like here the price moved below and created a lower low. So this is the indication that the strength of the trend is weakening and you have to get out of it, or it will just crash down and it will take all your profit. This was the first technique, and the another technique is, as soon as the price moves below these 2 moving average, like it did over here, you need to get out of the trade. No matter what, you need to get out of the trade, and this is how you have to use this strategy. Now, before we end this video, let me talk about the sponsor of this video. So the sponsor of this video is xm.com, and xm.com is one of the top trusted global broker. It provides you with more than 1000 plus trading instruments and more than 800x leverage. You can trade Forex, CFDs and cryptos on this platform. And not only that, but xm.com provides you with a personal account manager, access to Forex market research, webinars and many other video tutorials. To open an account with this broker, just go to my affiliate link given in the description below and get a sign up bonus. Thank you so much. See you in the next video.